right, welcome everyone. Thank you for joining us for this Connect conversation. Today we're going to talk about something a little different, private assets in DC plans. That's a topic we haven't covered at NAGDCA before, and I'm excited to do it. And joining me on this very important topic is Steve Ulian. So welcome, Steve. Steve is the head of the managing director of Defined Contribution and Retirement at Apollo. So welcome. Good to see you.
Great, Matt. Super to be here and looking forward to the conversation.
So like I said, we haven't talked about this very much. It's a pretty new topic. Some of our members are probably a little bit familiar with private assets because they've seen that their defined benefit plans are using them or they're familiar with them from those conversations. But can you talk a little bit just in general terms? What are we talking about when we're talking about private assets?
Yeah, no, it's a great question because I think if you asked most people, you'd probably get a different answer from every fifth person or every fourth person. So when we think about private market assets, Matt, we think about really the fact that private markets have been in existence for 40, 50, 60 years, arguably even longer. And we think about them as just another asset class that professional portfolio managers, professional fiduciaries can have as an arrow in their quiver to build portfolios that can fulfill the needs for the constituent that those portfolios are being built for. So, in the past, I think most people would say private markets and they'd say, ooh, private equity, hedge funds, buyout funds, highly levered. Yeah, and we don't think of it that way. Now if you sort of look at what private markets are today, you've got certainly have private equity, traditional private equity, which typically was buy a company, fix it up and flip it. But you also have other types of private equity that are much more in the lines of like what we do in many of our solutions, which is to buy and hold companies, take advantage of the actual corporate structure, cash flows, and the like. Then you've got real assets like real estate or infrastructure, and then you've got, I think, really a burgeoning asset class in privates, which is private credit. Which, if you look at least at Apollo, we manage roughly $100 billion of assets, and 500 billion of that now is private credit. So think of it as asset classes within the ecosystem that are similar, not too dissimilar from equity and fixed income on the public side. The only difference is these are private assets.
Okay. Yep. So kind of a good parallel. Private equity, similar to public equity, just not traded publicly as you would expect. And then you talked about private credit and private credit. Often, I mean, there are different forms of it, direct lending, all kinds of different flavors, but they're all kind of encapsulated in that term of private assets right now, right?
Yes, and I like what our CEO Mark Rowan says quite often, which is again, people used to equate private equity to very risky, high octane type of solutions. And Mark has a quote which I think is really spot on, which he says, "Look, public markets can be safe and risky, and private markets can be safe and risky. There's a range across of risk across the risk spectrum in either case, and we believe there's somewhat of a convergence going on between public and private. And again, our goal is to be able to make available to professional money managers, professionally managed solutions, give them access to these asset classes that heretofore have really been sort of off limits, especially to the defined contribution landscape and even in the wealth management landscape. So that's really what we've been doing over the last 3 to 5 years is bringing the access of these important asset classes to a wider range of investors."
That's great. And so, like I said, in the public space, there's been a lot of involvement in the private markets for a long time through the DB mechanism, right? And for a DB plan who controls a pool of asset, they're very much working, with a general partner, and they're actually going in and doing deals. In the defined contribution space, it's going to look a lot different, right? So how is that different? That what a DC plans manager, our members would be seeing and the discussions they'd be having versus what the DB side does in private markets?
No, it's absolutely the right question. It's a great question. So I kind of take let's take a step back and sort of talk about the evolution of
Okay.
defined contribution and the evolution of private markets. So we'll start with private markets. So all of the members of your organization that have DB plans most likely bought their private markets in this manner. Give Apollo or one of our peers a bunch of money for 10 years, lock it up, right? In a closed end type of a strategy. You know what? Every once in a while, we might call a capital call because we might want to invest more dollars and deploy it into that particular entity. So we may call you for capital calls. We'll sporadically, episodically give you the chance to get some money back if you need it from that investment. And we're going to charge you what we're those institutional private manager type fees, which could be 2% with 20% performance, whatever the case may be. That structure doesn't work in DC, right? The drawdown fund structure just doesn't work. And by the way, it didn't work in wealth management either.
Okay.
So what's changed? The dramatic change, I think, over the last 3-4 years has been the move to semi-liquid evergreen solutions in the private markets.
Can you explain that a little bit?
Sure. So, as opposed to giving somebody your money for 10 years, 7 years, whatever the case may be, evergreen solutions look, walk, quack. They're not 40 Act funds, but a little bit more like a 40 Act fund, right? In the sense that these structures are built so that a first dollar going in is immediately invested in the strategy. There's no J curve waiting for your dollars to be deployed to begin earning some type of a return. They're much more flexible in terms of their ability to offer subscriptions. So whereas you might have been able to subscribe once a year or maybe even in a longer time frame, here you can invest typically monthly subscriptions, and you can get your money back. In some cases,
in the DC plan, right?
Which is important for a DC plan. It's also important for a wealth management firm who's advising retail wealth clients. And so typically you can get your money back monthly or quarterly through a redemption process. So those semi-liquid structures really came into play, I'd say 3 to 5 years ago. Some have been around a little bit longer. And we at Apollo really embraced those structures. And so for our wealth management business, which interestingly, 3-4 years ago, there was one person in our wealth management business, and now we have close to maybe 160, 170 people.
Okay.
And the reason is we created a suite of 11 semi-liquid evergreen structures that the wealth management advisor could bring to their clients in a much easier manner.
Okay.
Well, what did we do in defined contribution land? We took those semi-liquid evergreen structures and we placed them in CITs, collective investment trusts, which I'm sure many of your members are using in their DC plans.
Yeah.
And that allows us to go the level of getting, what I'd say shovel ready for DC, where we can provide things like proper liquidity to the upper level manager, and we can create valuation that's appropriate for DC. We really solve what I call the plumbing issues by taking the semi-liquids, placing them in a CIT, and then 100% of the time so far, and I think probably will be the case for as long as I'm kicking around, we then take those CITs and we place them inside a professionally managed solution, a target date fund, a custom fund of fund, a target risk fund, or in some cases managed accounts or advisor managed accounts as you go down market. So if you think about the evolution of private markets, moving from drawdown funds, very closed, if you will, semi-liquids, DITs, and then if you think the evolution of defined contribution plans, I've been around, unfortunately, long enough to have seen most of this. DC comes around, mid 80s, late 80s. Ted Benna, God love him, has created the defined contribution plan, but by looking at the tax codes and finding 401k in the tax codes.
Yep.
Right as many organizations were sort of terminating or freezing their DB plans, Ted Bennett comes up with the 401k. Corporate America, especially, embraces it, I'd say. And we ask 120 million Americans to plan for, invest for, and execute a retirement program for themselves. That's tough, right? How many Americans can really do that? So I call what we've been doing for the last 15 years DBifying DC. It's the DBification of defined contribution. Started out with auto enrollment, auto escalation. Let's get people in the plans, just like DB plans did. By the way, let's help them invest. Let's create target date funds. Let's create custom fund of funds so that a fiduciary manager can manage the money on behalf of the participant. And let's create a paycheck for folks in retirement, which is what you're seeing now in guaranteed income. Mm-hmm. And on the investment side, I think, most participants, I think 80% of the flows now going into DC go into some type of a managed solution. And if a managed solution is being managed by a CIO office at one of your state plans, or if it's being managed by a consultant or an advisor, shouldn't they have the same tools at their disposal as a DB manager had back in the day?
So we've seen a lot of interest in the topic of private markets increasing. Do you think that's why? Why now? Just there's kind of been this convergence of the evolution of the DC side, the evolution of the private market side, and it's just kind of met.
Absolutely. I don't think without the two pieces happening, this would be what's going on now. You had to have the evolution of the private markets. You had to have structures that could play in the DC ecosystem, because I ran record keeping shops for the vast majority of my career at some of the largest record keepers in the country. And as a record keeper, I really don't like investment vehicles that don't fit the plumbing of my record keeping system. Okay. And so as we set out on this journey a couple of years ago here at Apollo, we really took that stance of we have to build something that can easily work within the existing DC ecosystem. And so that without the semi-liquids, I don't think that would have been possible. We do have one client actually who does use drawdown funds in their target date fund. Okay. They did it 6 years ago, prior to semi-liquids really being available. Mm-hmm. We spoke with them a while back and told them what we're doing now, and they were like, "Oh, we wish we had had this 5 years ago, right?" Because the semi-liquids really help get us to where we need to be from that standpoint. And then at the same time, you have to have the evolution in DC. You had to have the move to fiduciary type of investment management. And so, I think that's why now we have this move towards private markets. I also think that, it's harder for active managers in the long only space to beat their benchmark. And so if you think about it from just a pure performance standpoint and investment standpoint, what private markets can allow for is a great source of alpha in terms of actual performance. In many cases, in a lower volatility manner, and so lower vol, and with more diversification. So that having that, and that's why, by the way, that's why private markets have been used in defined benefit plans for the last 40 years. Yeah, because they offer those attributes.
And so when you were talking about the different vehicles that you would have access to private markets through, it's not necessarily a private markets only fund, right? We're talking about part of a larger structure. So can you talk a little bit about what some of those look like in practice? I know you have one with State Street. There's one, Capital Group is talking about putting one out, and a couple of other companies. Can you talk about, not just yours, but kind of how those would be structured and why you're not just buying private assets, right? You're buying within kind of a bigger, more diverse picture.
Yeah, absolutely. Thanks, Matt. Great point. If you think about the target date fund that we built with State Street, it's 90% publics, 10% private markets. We have several other solutions in market where it's roughly 75 publics, 25, or 80% publics, 20% private. So yeah, I think, for the most part, people are thinking that private markets will be somewhere in the 10 to 15% range in terms of the allocation within the professionally managed solution. There's some SEC guidance in terms of what percentage of a portfolio should be private within sort of the 40 Act mutual fund world. I think it's 15% there. So I think there's some comfort around that from plan sponsors and consultants and advisors. So yeah, we're talking about a 10, 15, maybe 20% allocation to privates within a portfolio that offers the rest as publics, which is important because you get a lot of the liquidity that you need for things like benefit responsiveness, loans, withdrawals, hardships. You get that from the public side of the portfolio without necessarily having to tap into the privates, knowing full well that you have the redemption rights monthly or quarterly from the privates if you need it for things like rebalancing the portfolio, or if a plan leaves the target, takes their money out of the target date fund, you're protected because you have enough liquidity in the rest of the portfolio.
Yeah, so you used the term plumbing before to talk about that, kind of like the details, right? How all this would actually work going back and forth. And there's been some hurdles that the private market industry has had to overcome to kind of make this leap into the DC side. Liquidity is one, like you mentioned. What are some of those hurdles, and how exactly are you building structures to try to overcome those, so that if I, like you mentioned, if I need a loan, or if I'm going to retire, our folks retire a lot of times younger, 50, 55, those dates creep up, and you need to start to withdraw, right? You can't wait. You need the money. So how is the kind of plumbing end of things evolved from the private markets to make it more amenable to the structures that are in DC plans?
Sure. So I'd say three things. Number one is first the semi-liquids. That was that was number one. Secondly, not all redemption rights are the same, depending who the asset manager is, or who the private market manager is. And thirdly is scale of the solution that you're adding into your portfolio. So we already talked about the evergreen structures. In terms of redemption rights, again, we have some redemption rights that are actually monthly. Most are quarterly. So if those are your redemption rights, what are the redemption rights of? And I think it's important, if I was building a portfolio with private markets, I'd want to have the redemption rights be at the 5% of the fund level.
Okay.
So not 5% of my investments as a client, but 5% at the fund level. And that way you have a broader pool to get that quarterly redemption out of. And that ultimately then leads to scale too. So we have I mentioned 11 semi-liquid structures and strategies. Probably 4 or 5 of them are what I call really, really DC ready. And that's because they're big and they have scale. Okay. So if I'm going to go into a target date fund with one of my solutions, the one that we're using with State Street happens to be $20 billion in size. And so 5% of the redemption rights on a quarterly basis of the unlocked shares of 20 billion is a pretty big number. And so that gives the comfort to the portfolio manager, whoever we're working with, and to ultimately the plan sponsor and the consultant, that there's going to be, if needed, the plenty of assets to provide liquidity. So I think those are the things that from a liquidity perspective that you have to look for. Is there scale? Of the strategy that you're thinking about including? What are the redemption rights? And then, we go through a bunch of stress testing in all kinds of markets. 2008, for instance, go through the stress testing. What would have happened if there was a DEFCON 1 scenario? Through all of that testing, all of that work, we really found that there's always a risk. I don't want to say there's never a risk, but there's virtually no scenarios where a plan sponsor, participants can always get their money at benefit responsive. Because if you think about how participants get liquidity, the record keeper nets out contribs and redemptions before it even gets to the target date fund or the managed solution. Then you have the managed solution, which has 85, 90% in publics to have liquidity. Then you get to our little CIT that's inside that portfolio, which some people will put a cash buffer even even within that. So you've got 3 levels of liquidity that it's very, very hard to actually break that in terms of having to, put a gate in. Worst possible case scenario, everybody wants to leave at exactly the same time, kind of like stable value. Could there be a gate that gets put up? Yeah, there could be. All of the work we've done has said, in a scaled solution, you might have to wait a quarter or 2 if you were a plan that wanted to exit and all kinds of heck was breaking loose. You might have to wait. But again, that's not the norm in any way, shape, or form. So that's how liquidity works within the portfolios.
Okay, that's helpful. So our folks, all government members, I know that you've had interest from both the private side and the public side. Are you getting different questions, or are there differences with the governmental DC plans, either with what's being asked or how you're talking about it than what you're seeing on the private side?
Subtle. I would say the interest in private markets in a professionally managed portfolio is strong from both corporate and public.
Okay.
I would say the corporate side is a little more trepidatious, probably because of things like litigation risk. Is possible that there might be a little more trepidatious. On the public side, I'd say many of the public plans that we're talking to have, again, defined benefit plans. They've been utilizing firms like Apollo for years and years and years. Very comfortable with how private markets operate. Very comfortable with the benefits of having private markets in their portfolios. So those conversations tend to be, again, not all publics are the same, but certainly in the large public plans, who might have CIO, a CIO, a chief investment officer, or a
Right.
CIO office. They are very, very interested in not only privates, but maybe even building bespoke solutions within the private, and then putting those in their portfolio. On the corporate side, we're getting a lot of interest as well. And I'd say that, we have probably 5 or 6 live conversations going on right now in both sectors, public and private. But I think the consultant community and the advisor community are all very much, I think, aligned to the fact that, it does make sense for what is typically long dated assets to take advantage of private markets. And they now see, I think, the plumbing can work through what we and others have done. And they're very much about, let's see if we can make this work in our portfolios.
Okay. So we do have to cut it off there. We could talk a lot more about this. There is a lot to cover. So just for all of you, we are going to extend this conversation into the conference. So we do have a session. Steve will be talking, joined by David Levine and a couple of our other really big brains on this topic. There is a lot, we'll get into fees, we'll get into the plumbing, we'll get into how this works, and we'll hear from some plan sponsors as well to think through how private markets can integrate into DC plans and what are some of the risks and how do you have to think through it. Hopefully this helped you get a baseline. I really appreciate, Steve, you coming on to start that conversation. Like I said, we'll continue it in October. We look forward to seeing you there and really appreciate you coming on today.
No, thanks, Matt, and hopefully helpful and not too confusing, but really excited about it and excited to join you at the conference. So thanks for having me.
Yeah. All right. Thanks a lot, everyone.
Bye-bye.